Short selling is a way to profit from falling stock prices. How exactly this works and why it is a seriously dangerous tool that could break your financial neck, I'll explain you in this video. Taking a short position or a long position in a stock of a company doesn't have anything to do with short-term or long-term trading. These are just terms for certain financial tools and don't have anything to do with the time horizon of the trade. The usual way of engaging with stocks is that you would buy the stock, expect the company and its stock to gain in value and preferably also in price over time, and then sell the stock with a profit or just keep it forever and live off the dividends. This is called a long position. But imagine that you would know about a company that is just ridiculously high priced. You maybe see that the company's market will collapse in the near future, but the stock market doesn't get it yet. And as you know that the company's stock price will also go down in the near future, you want to benefit from this understanding. For this, you build up a so-called short position, or in other words, you sell a stock short. Selling a stock short is the opposite of a long position. When you sell a stock short, you're borrowing a stock from a broker and sell it immediately. Let's say you do this at $100 per stock. The money from the selling operation is transferred to your so-called margin account. And then you wait. Let's say everything worked out for you. The stock price of the company actually tumbled down like you predicted. You remember that you borrowed that stock in the beginning from your broker. To close out the operation, you now have to give back the borrowed stock to the broker. To be able to do this, you need to buy the stock at the stock market. As the stock went down from $100 to $25 in this example, you have to pay significantly less for the stock. Your profit is what remains in the margin account. That is the difference between the short selling price, in this case $100, and the price of $25 that you now paid to buy the stock, minus the costs for the broker. You may have already heard that short selling is an extremely dangerous tool. This is actually true. Obviously, a short selling operation can also fail. When the stock price is going to increase instead of decreasing, the price that you will have to pay later for the stock will be higher than what you received for the short sale in the beginning. Your loss will then be the difference between the short selling price, in this case $100, and the buying price, plus the costs for the broker. You will have to make sure that your margin account is covered according to the rules for margin accounts in case the stock price increases. Otherwise, your broker will close the position by buying the stock from the money in your margin account and will claim back whatever you owe him on top of that. And this is where the huge danger of this tool lies. Your potential maximum profit is basically limited to whatever you get for the short sale minus the brokerage costs. But your loss is theoretically unlimited, as a stock can continue to rise further and further. There are sometimes even market situations when there are more stocks required by the short sellers than there are stocks available in the market. The short sellers have to close their positions, but they can't. And now the law of economics hits them like a hammer. When the supply is lower than the demand, only one thing can happen. The price increases further, because that's the only way to find further people to sell their stocks, even though that nothing happens with the company and the business itself. This is what they call a short squeeze, when the short sellers are squeezed out of the market. There are people who lost their complete existence in situations like these. This is why short selling is so dangerous. The thing is, you don't have to use risky tools like short selling to make a lot of money and to build up a fortune. In this video here, I show you how I increased my money 18 times by investing in a seemingly boring company, and I explain you what to look out for if you want to achieve this as well. See ya!